Welcome, Benny boys and gals. It's your boy, What the Duck. And the time is finally here. I know a lot of you have been asking about a charting class, so it is time for us to do our first ever Penny Boys charting class. So the first chart they're going to be looking at, as far as stocks go, is the stock Isaiah, I-Z-E-A. This is just a quick little screenshot of what it's going to look like in your mobile app for Webull. So what you're going to do is you would click this button here, and this will show all the different indicators that you have set. And you can click more to get to all the other indicators that we'll go over. And as far as the desktop version goes, you're going to click that button right here, the indicators. And the first one we're going to go over is the moving average. So moving averages are used to identify trends and confirm reversals. And it shows the average value or price of a certain time period. So moving averages can help you tell if a stock is trending up, trending down, or ranging. It's kind of meaning flatlining. And you can also tell if a trend is in motion, which is currently going up or currently going down and staying that way, or reversing. And the moving average, it is based off of the past prices, so it can't warn you of anything in the future, but it can help you confirm if a trend is taking place. If the price is above the moving average, it typically is on an uptrend, and if the price is below the moving average, it's typically on a downtrend. But it gets more complicated than that, which we will definitely be going over. And a trend reversal is a breaking of a moving average line. And when a price crosses over the moving average line, which is it breaking, it's a buy in theory. And when a price crosses below a moving average line, in theory, it would be considered a sell. Now, this is just one indicator. You can't just go by one indicator for buying and selling, but it is a very popular one. The close of the candlestick is what is the price that is factored into this. So it doesn't consider the open or all the in between of the candlesticks. It's talking about the close of the candlestick. And what I mean by this is that we're going by, so for a red candle, the close of the candlestick would be the bottom right here. And for a green candle, the close of the candlestick would be the top right here. So it opened here and it closed up here. Whereas, like, for instance, this red one opened here and it closed down here. And we'll go over candles and all that later. That being said, the close of the candlesticks is also what determines if a price has broken the support or resistance. So if it closes above or below the support or resistance, that's what you're looking for. And the longer the time factored in, the stronger the support or resistance. For example, a 200-day moving average is a stronger support than a 20-day moving average. Also, the longer time period the moving average holds as support, the more significant it is when it's broken. So if the moving average is the support and it's being held as support, and then it's for like a long time, and then eventually it breaks, it's going to be more of a indicator that the price might be either going down or up depending on which way it breaks. And if a price is above the moving average, it's on an uptrend, and the moving average is the support. So if the moving average is down here, the moving average would be your support. And if a price is below the moving average, so the moving average is just up here, then it's on a downtrend, and the moving average is a resistance that the price needs to break through. And once the support is broken, it becomes a resistance. So this is support, and the price goes below it, then now that line that you're using as the support is now the resistance. And the thing about moving averages is that it is something called a self-fulfilling prophecy, which means the more people that use a certain moving average, the more often it will act as a support and resistance, because all it is based off of the price. It's just different mathematical equations based off the price. It's not any type of magical line that, once it hits it, it has to go up or has to go down. It's all based off of what other traders are doing. So if more people are using it, then it's going to be kind of become true. So we have three popular moving averages. You have the SMA, which is the simple moving average, which is usually used for long-term trends. And you have the EMA, the exponential moving average, which is typically used for short-term trends. The reason why is because the longer one, the SMA, the simple moving average, it has more lag and is slower to react. And this makes it slower to react to rapid price changes and the calculation of your average price of a certain time period, whatever you have set on it. Whereas your your EMA, which is your exponential moving average, is used for a short-term trend because it responds quicker to price action and it reflects quicker shifts in sentiment, which is supply and demand, or news, events, etc. It also has a little bit of a different calculation than the SMA, and that's why it has that faster response time. It's based off the calculations that is used in order to determine the SMA versus the EMA. Then you also have the WMA, which is the weighted moving average, which we'll be going over in a future video. So first, we're going to be setting up the SMA, which is the longer term period moving average, or used to look at longer trends. So you're going to go to indicators. You're going to click moving average. And in order to edit your moving average, you're going to go to edit indicators. So now you have your moving average that comes up. So now you have all these different lines and numbers, which are going to be the lines. And what these numbers are is what you're going to be setting your moving average to, as far as what you want the number of days to be as far as your line goes, your moving average goes. So you can have a 10-day moving average, a 50-day moving average, a 200-day moving average, which is basically the average price of the 10 days, 20 days, 50 days, depending on what you set it. And as you can see, it all says length. So these are the lengths of your moving average. So a lot of traders, a lot of people use the 50-day, 100-day, and the 200-day as far as your longer period of time goes for your simple moving average. What I usually use is a 10-day. So you're going to set that as 10, 50, and I use 180 as the longer one. And a lot of people can also use more than 3. I'm just going to use 3 for now to make it a little bit easier to look at. But so you can do a 10, you can do a 20, a 50, a 180, and then a 200 if you really want to look at all the different types of averages. But we're going to use 3 for today. So 10, 50, and 180. You go to Style to make sure that you have them all selected, otherwise you won't be able to see them all. And you want to change the colors just to make sure that they're all different. So what I'm going to do is I'm going to use, let's see, so it's going to be a white background screen. So I'll do dark blue, I'll do orange, and we'll do, let's do like a purplish looking color. So we have dark blue, darkish orange, and that purple. So now you're going to press OK, and as you can see, you got your dark blue, your dark orange, and your purple. So these are your moving average lines. The purple, if you look right over here, it'll tell you what all those different moving averages are. So the blue is a 10-day moving average 10. You have your orange is your 50-day moving average 50. And right here, the purple is the moving average 180. So this is showing the average price of the past 180 days, the past 50 days, and the past 10 days. So if you think about it, if the price is currently going up, that means the past 10 days the price has been increasing, which means that the 10-day moving average will start increasing. So that's how you know that the price is going up, the moving average for the 10 days is going up. If the price has been going up long term, that means that like the past 180 days is continuing to go up and up and up and up and up, then your 180-day moving average will be looking good. It'll start be going up. What this shows right now is that the price has been going down long term because the past 180 days, the average has been slowly getting less and less as far as the price goes. And in order for that to happen, it means that each day the price has been going lower and lower from 180 days out. So as far as a trend goes, for a uptrend, what you want is to see the blue line, the moving average 10, to be above the orange line, the moving average 50, and you want the orange line, the moving average 50, to be above the purple line, the moving average 180. So as you see right here, it's like in this current situation right here is actually trending down. because the average price of the past 10 days is actually lower than what the average price of the past 50 days is, which means that short term, the price has been going down. And same deal with the 50-day is below the 180-day. So the price has been going down even in that sense in the 50-day to 180-day longer term. So one way to use the moving average, besides looking for trends, as you can see here, this is an uptrend because the blue line is above the orange and the orange is above the purple. So this is trending up, it's trending up, it's trending up, whereas a downtrend would be the opposite, where the purple line is above the orange and the orange line is above the blue. This means it's starting to trend down on the longer term. Another way of using it besides trends is to use the moving average as a support or resistance. So as soon as these lines all break, that means right now the price is going up, and you can start to use this 50-day moving average as the resistance. I'm sorry, as a support, because the support is below the price, the resistance is above the price. So right now, one way of using this moving average is you're using the 50-day as your support. So what you want to see is if the price goes below the 50-day moving average, that means it's breaking down past the support, which is not a good thing. And once that happens, then you're going to use the purple line as a support. So you got your price, which is basically the blue line, because that's the closest to the price action. And you have your orange, which is your first support, and the purple, which would be your second support, as far as a longer term trend goes. So it's going up, so it's above the support. Here it's starting to go down, and if it bounces off this orange line and keeps going up, you know that you're fine. That just means that this is some consolidation, because sometimes the price, even though it's going up and it's trending up, it's not just going to go straight up like an arrow. It's going to zigzag a little bit like this. It'll go up, keep going up. People will sell for profit. Maybe it'll keep going up. People will sell for profit, keep going up. As long as it's not breaking these supports, that's how you know it's a good stock and it's on a good uptrend. In this case, it did not hold the moving average 50-day line as support, which means it started to trend down again. Now you see how the blue line goes below the orange line. It means that the orange line is now the resistance. So as soon as that price goes below, it's now you're using your support, which was the orange line, is now your resistance here. And your hope is that the blue line will now break above the moving average 50 and keep going up, and it'll start using that orange line as the support again. Because support is a price that is below, the support is a line that is below the price, that you do not want it to go below if you are bullish. So right here, it went down below the support. So now that orange line is the resistance, because your support, once it gets broken, is now your resistance. And what happened is it bounced off of the resistance and it didn't go back up over it, which is what we would be hoping for if we're bullish. What happened was it used that resistance and it actually did hit the resistance and it went back down, as you can see. You see how the blue line did not cross back over the orange line. That's how you know, oh, it looks like it's starting to trend down. So you could know maybe if you bought down here, you're like, you could have sold right here right away, or you could have hoped that that this would have been just a little bit of a downtrend. It would have came back up, but it didn't. It hit that support and it went back down again, which is how you would know, maybe it's not a great time to hold on to that stock. So it's going down. It's going down. Now the purple line will be the support. So the price, which is that little blue dot, is going, and now it's getting close to that support. So now it looks like it can go closer. So it hit the support and then it went underneath the support. So now you're using this next line right here. You have these two lines that used to be your support. Over here you had your orange line and your purple line as your support. Now the price is below both those lines. Those are now both your resistances. So the price went down, hit that bottom over there, and now it broke that resistance. So now this orange line is your support. This purple line is your resistance. And what happened was it hit the resistance and it said, nah. And then it hit the resistance and it was like, yeah, no, I'm going to keep going. So now you're like, oh, it's going up now. It's uptrending. So this is a good thing right here. So hit that support, said nah. Sorry, hit the resistance and said nah. And what you'd be looking for is like, oh no, I hope it doesn't go down and break that support again and start trending down again. But look, it didn't. It broke the support. I'm sorry, it broke the resistance. So that blue line went above the resistance line. So now that purple line is your support as well as the orange line, because the blue line is above these. So those are now acting as your support. So in theory, if you were to get into this trade right when it broke the resistance, that means that you're bullish. And we'll go over how to use the support and resistance as far as trading goes in a little bit. We're just going to continue watching this. So what happens is now the blue line is above the purple and orange. These are now your supports. So you're watching, it's now trending up, it's trending up. And it's like, all right, let's see what happens. It's going to go to that support here. In theory, it would have been nice if it bounced right off of it. It didn't. It dipped right below. People were selling, and then it came right back up again. So you're thinking to yourself, all right, it didn't show the strongest price movement right here because it didn't bounce off of the support, but it also stayed above your 180-day support. So it broke that first support, but it didn't break the second support, and it kept going up. So if you're long term, you might have still held past this to see if it went down below this purple line. If it did, then that might be a time to sell. If you are long term, for a short term day trader, if you had bought it right here, maybe you would have sold up here because you never know what would happen. But if you held, it actually went and it hit that resistance, that orange line, and it went above the resistance. So now we're trending up again because you see how the blue line's above the orange line line's above the purple line, and that support's kind of staying still right over here, that bottom purple support line. So your price is going up, it hit that peak. Now in theory you would hope that it would just continue to go up, go up, go up, kind of do that little zigzaggy up, sell, buy, a little sell off, buy. The whole time that it would be doing that, though, the blue line would be above the orange above the purple. That didn't happen, though. It not just got sold off, it dumped, and it dumped past your support, so it didn't bounce off like you would hope, because I gotta charge my battery. So we would have hoped it would have went down, hit that, and then boom, bounced right off. It did not. And it went back below the moving average 50-day line. So now your 50-day line is your resistance. The purple line is your support. So now your hope is like, all right, let's see if it can bounce off that purple line and go back and then break that orange line and get some good uptrend. It didn't. It went below the purple line. So now it's trending down. But luckily, it didn't start dumping too hard and start trending down for too long because it went right back up above that purple line. And this is why you can't only use one indicator, because if you had been only using this indicator, you would have sold right here, and if you wouldn't have been able to use the other indicator. You would have wanted to use other indicators to see why this is happening, if maybe the volume's still good, or if the MACD or any of your other indicators that we're going to be going over could tell you something different that this isn't telling you, because you can't just use one indicator. It's like trying to drive with only your mirror on your passenger side. You're not going to do that. You want to use your mirror on your driver's side, on your passenger side, and your rear view mirror. And you want to turn to your left and turn to your right when you're switching lanes as well. That's kind of what we're doing. We're driving a car right now. Right now we're only looking at our passenger side window mirror, and all these other indicators we're going to go over is the other mirrors that you need to look at as well while driving. So anyway, now it's trending down, and boom, it went above that resistance, which is good. It went above that resistance, which is good, but then it's like, nah, it went back down again. And then something must have happened here. You can see all the volume, which we'll go over as well later. Something happened here that spiked it up. So now, boom, we're trending up again. You got that blue line over the orange line over the purple line. We're looking good. We're looking good. People sold off. That's fine. People selling off. Long term, that's fine. And oops, it did not hold the support. So now we're going back down again. But it looks like it bounced off that purple line, which is not a bad thing, which means that you know that maybe this might be a time to either average down or buy in, because here it goes, and then boom, it crossed above again. So now we're looking at an uptrend again. Blue line's above the orange, orange is above the purple, and this is just an uptrend based off of that one passenger side mirror. It's based on the one indicator. So that's basically how you use these as far as the uptrends go. What you would do as far as like buying goes. So let's see here. So it's trending, here it is. So it's trending down. What you could do, so as far as using this to determine when to buy and sell a stock, this is the SMA. This is the longer term moving average. So you typically wouldn't use it for day trading. So you wouldn't like use it to buy here and sell here. You would use it to buy like more of a longer term hold, or like a swing trade. So let's say you're watching this stock and you see, all right, it's trending down. You got your blue lines down here, and you say, all right, it looks like, oh, it's starting to trend up. The blue line crossed above the purple line, across above the orange line. So maybe you already have it. Maybe you bought it down here. Maybe you're just going to start buying it right here. So what you're going to do is you're going to watch to see. All right, so you bought it here at 1,375. Right when it crossed. Boom. So you're like, all right, let's see if it's going to hold that. So you bought it at 1375, and you see that it's still trending up. You see that it hit that support line, the orange support, and it kept going. So you're like, all right, I'm going to hold. Now, since you're a long-term investor, even though it crossed below here, you're going to watch to see if it's going to cross below your next support line, which it didn't. You can see how the price bounced off of it, not once but twice. That's pretty strong. That's pretty. It's a pretty good indicator that that support line is going to be held as a support line. And as you can see over here, remember what I said, that if the support line is used longer term or used a couple times, it's going to be a stronger support. So right here, it bounced off that support, and it used that support again here and here. So now you're like, all right, this is a pretty strong support line. That moving average is 180. So you're going to keep holding from your 1375 position. And now, boom, it's crossed above. Now it's trending up again. So you're like, all right, good. So it's going up, it's going up, it's going up, and here it's going back down again. And this is, this is if you're long term. In theory, you could have sold some up here, but if you're holding really long, you're going to watch it. It's going to go below, and as you can see, it used that resistance. I'm sorry, that support once again. So that blue line bounced right off the purple line. So you're like, all right, I'm going to continue holding. It's continuing to use that support line. And then now it crossed above the resistance, it's trending up, and it's getting sold off again, and boom, it bounced off the support. That's good. But now here at 1387 is where it started to cross down. So in theory, you could have sold there at 1386, 1387 because it started to trend down, or you could have, you could have held and just to see if this was an overreaction, because a lot of the times what people like to do is they try to create a stop loss rate, which means that they try to make the price go below that support to make people sell so that they can get those cheap shares and buy it back up again. So like right here, people sold it. So you could have held for a little bit just to make sure it wasn't a stop loss rate, and you could use other indicators to determine that. And as you can see, it actually did come back up, and it's now starting to use that uptrend is starting to use these as supports now. And then as you continue going forward, so that was the only time it went down, it went past that purple line, it went below that 180 support. So over here, still using that support. It's really trending up now. Now you're still up. You bought it through 1357, it's at 1410. It crossed above and below that, using that orange line as support. So shorter term, it was trending up, trending down, trending up, trending down. But long term, it didn't break past your 180, which has been used as support for a long time now, ever since you bought. So it's a strong support. Continuing to hold, it's still above that 180 line. You're good to go. Like, holy crap, you're up a lot now because you bought at 1375. And maybe here is when you decide, all right, let's see. So it crosses below. Now your 180 line is the top line. That's not good. So you see, even, let's see where we were when it crossed. Even here, when it crossed below, here across below, your purple line is still up below your moving average 50, so it's not a complete downtrend. And even here when it crossed underneath, even when the blue line crossed underneath, your purple line, your moving average 180 is still below your moving average 50. So it's still not a complete downtrend. It's only a complete downtrend when the purple line is above everything. And then even here, it almost did that and tried to trick you there, but then boom. It was just for like a split second, possibly because that stop loss rate affected the price a little bit. So people might have sold here and they would have been, out of luck because it came back up again. So you want to look for a strong, solid break of support if you're holding long and strong. You have done your due diligence, which we went over last class, and you know that it's a strong stock because what happened was here, it wasn't just a stop loss rate. You can tell because not only did that support get broken, see how the blue line and the price goes below your purple line. Not only that, but now the purple line is your top line, which means it's starting to trend down. You see how you have your 180 above your 50, which is above your 10. This is probably where you'd be like, oh, I'm not, this doesn't look so hot. I might try to sell. So you bought in at 1354. So now you sold at 1741. And guess what? Because you're able to read this, and you can see that it's still trending down, because that purple line is now on top. As far as the trend goes, the purple line is the top line, the 180-day moving average is above everything else, which is a downtrend long term. So now, it's a good thing that you sold over here, and you might have sold here or here once you realize it's not coming back up. And even here, when it decided to break that 50-day moving average, it didn't go ahead and break that 180. It went right back below again. And as you can see, it just didn't go above that resistance. So ideally, you could have maybe bought if it broke above there. That's when you would buy again, but it hasn't. See, it's still using that 180-day moving average as a resistance until right here. The price crosses above just for a split second, and then it goes back below again. So it's still trending down up until here. Now, boom, now we're trending up a little bit. Or in this case, it's kind of trending sideways because you see how it keeps going back and forth here. So that's kind of like a sideways trend, which is kind of just, it's kind of sideways, going sideways is not shooting up or shooting down. And I think that's actually where we are today. And another way of using this, the last way to use the moving average, this SMA, is what you would do, especially for like a breakout, for instance, is you would use the candles and the current price, and you would base that off of the moving average. So usually you would base that off of the shorter moving average, which is the 10-day moving average. So as soon as you see how the price is right here, so it's below, it's not closing, the candle isn't closing above it, even though right here the candle went above that blue line, it closed below it, so it's still trending down until like right here. You got that one candle right here where it closed above the moving average 10. That one closed above the moving average 10. This one closed above the moving average 10. Even this red one closed above it. So you might buy around here, and if you're looking for short term, you might sell right here when it crosses below, or if you're a little bit more, have a little more hands of steel, you might have held and waited for it to cross below again right here. Or what you could have done is, if you had the day trades, you could have bought here when it crossed above, sold down here, and then waited for another confirmation, which is right here. See, it closed above, maybe you would have bought right around here when it's closing above, and then you'd wait until it got crossed below and sold down here. So that's how you can use candles with the moving average, is you wait for the candle to close above like 1 or 2 times, maybe 3 for strong confirmation, and that's when you would buy, and you would wait until it closed below. And as far as support and resistance goes for that, as soon as the candle crosses, that's when the blue line now, since the price has closed above the blue line, your blue line is now your support. I'm sorry, where the price crossed above is your support. So in this case, the support is 1494, it looks like. And it's going up, and then across below, and then across above again. So now your new support is right up here around the 1515 mark. So it goes above, which means that 14, the price around here is your support, and that price being 1492.93 is your support. And it doesn't go below that, but then it crosses down here, and then it crosses above, and now you have a new support, which is 1514. And then once it does the same thing again, it closes below, goes above. Now your new support is 1515, and so on and so forth. Oops, here we go. So like for example here, and the same thing works for resistance. Once it crosses below, now your resistance is this line, right? Is this price right here? 1755 is now your resistance. So you'd wait until it breaks above the resistance, which it didn't, which means it's still kind of trending down long term. It hasn't crossed above that resistance, and the resistance being where the candle closes below that SMA 10. So your SMA 10 is your support. It's your support. As soon as your SMA 10 becomes your resistance based off the candle, that's when that price right there becomes your. You can like maybe even put like a trend line right here, and that would become your resistance. And we'll go over how to use that with the candles and all that in a little bit. Now, as far as those using the candles as your to determine supports and resistance, it's a little bit harder to do that for the short term with, or just in general with your SMA, because the SMA does not react to the price as fast as your EMA. And your EMA, let's get rid of that moving average, the SMA. Your EMA, so if you go to edit indicators, you can find it right here, is your exponential moving average. And it's the same kind of deal. You said it the same way, but the difference is that the exponential moving average is used more so for short-term trends because it responds faster to price action. So what I'm going to do is I'm going to set my I'm going to set my EMA, exponential moving average, to 5, 10, and 20. So as you can see, this is more of a shorter term trend because I'm using my 5-day average, my 10-day average, and my 20-day average instead of the longer terms that we were using, which was the moving average of 10, 50, and 180. This is 5, 10, and 20, so it can be a shorter term trend. In the same deal, we're going to go to Style, make sure we have them selected so that we can see them. And we're going to set them as well. So we got the dark blue, got the dark orange, and we got the purple. To make things less confusing, so blue, orange, purple, and press done. And as you can see, you got these lines that looks very similar to what the moving average, the SMA, look like as far as the lines go. The only difference is that these are a little bit tighter, and they're used for, usually they're used for day trading. So what I'm going to do, so we're going to use them, usually use them for breakouts or uptrends when day trading. If you're bullish, you're usually not going to day trade a stock that's flatlining and just kind of going, sideways, unless you're just trying to quickly buy, sell off like 2 cent ups and 2 cents downs over and over and over again. But for those who do not have those big accounts and can't do that, you're usually in a day trade based off of these big fluctuations. So the same deal, you're looking for as far as an uptrend goes, you're looking for the blue line, your EMA 5, to cross over and stay over your EMA 10, and for that to stay over your EMA 20. So right here, you got your blue over your orange over your purple. That means it's trending up. It's trending up. It's starting to trend down a little bit short term, but it bounced off that resistance. It's still trending up. where did we go? So we're going to use a different example for this. We're going to use KTOV, K-T-O-V. And so what you're looking for is, like I was saying, you want that blue line over your orange line, but in order to start your trade, so if you're day trading this, first of all, you're going to look at your other indicators to, to determine how to find this day trade, maybe volume, for instance. So you see it has some volume or unusual volume. So what you're going to do is, so first of all, you can see it's uptrending. You see how the blue is above the orange is above the purple. That's a good thing. What you're going to do is you might want to wait until your candles go above your moving average, your EMA 5. So what I would do, maybe you wait around here. This looks like a good confirmation. Here it was looking a little sketchy because it went up. It did cross above, so some people might have bought around here. They're like, all right, look, starting to uptrend, and they would have had a sell loss, or stop loss for when it goes below the support, which would be the orange or maybe even the purple they would use if they're really feeling ballsy. So here it actually did, so it went above, the price went and closed for that candle above your EMA 5. So then you did it again right here, close above your EMA 5. So you might have said, all right, this might be a buy. I'm going to set a stop loss for either right here at 86 cents or right here at 86.35. Or if you're really feeling like, you don't want to play it too risky, you could have set a stop loss right at the EMA 5, but most people use the EMA 10 or 20 as a support. So your price, actually right here would be another time. So your price is below the EMAs, and then here it closed above, and it closed above again, and it's hard to see with the cursor over it, like the mouse over it, but you can see how here the candle, the end of the candle, is closing above those lines on 1, 2, 3, 4, even 5, 6 of these candles. So any of these you might have said, oh, maybe I'm going to buy. It had a little volume over here, it looks like. Maybe I'm going to buy, and I'm going to set a stop loss, which I'm going to continue to move up as the price goes up, and I'm going to set the stop loss at the EMA 20 or maybe the EMA 10, depending on what your risk tolerance is. So you buy, you're going to be buying here 85 cents. It's going up. It's going up. Even though here it did go below the EMA 5, you see the little bottom wick of that candle is still closed above. So you're going to continue holding. It closed above, it closed above, it closed above. Now this is the candle that people are selling off. This is the candle that people are trying to get your stop losses to trigger. So if you had a stop loss right here, like right below the EMA 20, you would have been fine. You would have held on to it. If you had a stop loss right below the EMA 10, you would have sold out. And you would have been done with that trade. So you do got to be careful with these candles because sometimes it'll show that it's going down, but it'll come right back up again. This is people just trying to get rid of some of the traders who had their stop losses set at the EMA 10 or right above the EMA 20. So you could have set it right here, like right below. So right here, the candle's crossing above, actually right here, which means that the support is technically 85 cents. So even though it did cross below, what you can do with candle patterns is you can use where the price crosses above the EMA line as your support. So like in this case, it crossed above and it stayed above here at 0.8577. So that could be your support. Or you can use the lines as a support, depending on what you're looking for as far as your risk tolerance goes. So here it closed right above that EMA 20, which it used as the support, kept going up, went down a little bit, closed above, went up a little bit, but still closed above the EMA 20. So if you're using this as your support, you're fine. Kept going up, kept going up, kept going up, and you're still good. It's not closing below. Now here, now that you made some profit already, and you see that it crossed and closed below the EMA 5, you might, all right, this might be the dip. This might be where it starts to go down. This might be where I sell. Or if you're still using this as your support, you're going to hold on, and you see it keeps going up to 92. But that is on the riskier side, because once it does cross below, and here, even went below that EMA 10, but it did close above it, this would have been not a terrible time to sell. You wouldn't have been in the wrong. But if you held on and you continue to use this as support, it keeps going up. Now here, now it's selling off. Now you could have continued to hold because is still using that EMA 20 as a support. But then here, boom, this is where, so if you set a stop loss for the EMA 20 right below it, you would have set a stop loss at 89 cents. And boom, it would have crossed below. You would have sold here at 89 cents. If you didn't know how to read this stuff and you didn't have this set, it just would have looked like this to you. You wouldn't really know what to do. You'd be like, oh, shoot, like, is it going to come back up? I don't know. So with your EMA, you would have known to, there it goes. You would have known to set a stop loss right around here, and you would have made that profit from it was like 84 or 86. Actually, no, we looked at it right here where it crossed over at 85. This would be a quick day trade, 85 to around 89, or if you were, really feeling it, you could have sold right here at 89 again. It's around the same price. Or if you got lucky, you could have sold up here when it crossed down below that EMA 5. So these are all your supports when the price is above it. And you can decide based off your risk tolerance which one you want to use. Because if you use the first one, you're going to probably end up selling off quicker, even if it's still going up. But if you're at the top and you're using this blue line as your support, you would have sold right around here. You would have sold at 91 cents, which would have been the top. But you never know because it could have done what it did here, closed below. You see how this candle closed below? So in theory, that would have been a nice sell. But the same thing happened here. It closed below, then it went back up. So it's impossible to really tell what the top is going to be. You can just kind of only base your selling off of your risk tolerance. So even here, you see how it went below the blue line, it came back up again. Went below the blue line, came back up again. Where here went below the blue line, came back up again. Then it dumped. And then right here is where you would have been like, all right, this is really not looking good. Now it's really trending down. Your blue line below your purple. Purple is looking across. Actually, still not trending down too hard because the purple line is still in the middle. But went down to 87 cents. Maybe you held. Kept going up, it bounced off. Now it's crossing above that support. But in theory, you would have wanted to sell right around. Where is it here? When it crossed below your exponential moving average. Another way to use this, let's see. So for instance here, this is a quick one, but if you were lucky enough to buy like right around here, you see how these candles kind of closed above your EMA lines right here. So this is starting to show uptrend. So in theory, you buy here when it crosses above, and you would set a sell limit for that price where it would go back below. So you buy here at, let's see, 1537. You can even set a stop loss for 1537, or you can set a stop loss for your, you can continue bringing the stop loss up right below your purple line. In theory, your support is the price that the candle crosses above and closes above. So it would be where you bought right here at 1435, 1437. It closed above, it closed above, it closed above. Even here, it closed right on that blue line, and then it shot up. So now you're still holding, obviously. Here, it's using that blue line as a support. It went a little bit below, but then it closed above. Dipped a little below, but it closed above. Here, they keep dipping below that line, but it keeps closing above, which is good. So you continue to hold. Here it starts to dip down, but it's still using that blue line as support, so you continue to hold. Even here it didn't cross below, so you might still hold. Here it went below and then it closed right above that blue line, and then here is where it closes below that blue line. So that's where you would note to sell, because even though some of these are red candles, it doesn't mean that it's trending down still. And you're still trending up. You see how your purple line is below your orange, which is below your blue, and your candles aren't closing below your blue line up until right here. So you would have sold at 17.59. You would have bought right here at 15.35. So you have seen that the candles are starting to close above your price, right above your moving average lines. That's when you would start to know, this is trending up. Maybe I'll buy and I'll set a stop loss like right around here in the purple line, like for 15.35. So I'll buy here and I'll set a stop loss just in case it decides to go back down below this, which it didn't. It went up and it continued to use that blue line as support, so you're good to go up until right around here. And this is where you would think about selling. And then it kept going down. It closed now below the orange line, so now you're really thinking about selling. And now the orange line went above the blue line, so now you're really, really thinking about selling. And then the purple line now is going above the blue line, which is it's now starting to really trend down. And as you can see, it's continue to go down, consolidate. Not the worst, but you would have rather sold up here. So that's kind of how you use the EMA for reading the candles. You basically just want your candle to close above your EMA line, and that's how you know it might start to be buy, especially if you see like 2 or 3 candles showing that strength above that EMA. And once it goes below and closes below, that might be your sell point. If you go into your Fibonacci lines, your Fibonacci indicator, which you'll click this and a little button, a little scroll down will come down. You can go to edit, and then you would you scroll all the way down to like your moving averages, I think it's called. Yeah, so you would click indicators, then more, and then you would scroll all the way down to indicator categories. Under moving average indicators, you would see EMA, MA, and VWAP. Underneath that, you would see support resistance indicators, and that's where you find the Fib-LV, which is the Fibonacci level. And that's what these blue-orange lines are. And it's hard to see, but what basically that does is it automatically, in Webull phone, the mobile version, it automatically shows you some of these support and resistances. This blue line is like your middle line. So basically once it crosses above, that's your support. So you see how the price in this case is using that blue line as a support. And then once it crosses below the support, that's where you would sell basically. So if it goes above that blue line, that means buy. And now this is going to be your resistance, this orange line. And now it's going up, it's going up, it's going up, and now it crossed below that blue line, it means sell in theory. And we'll go over that in greater detail. In full detail, we'll be going over the Fibonacci lines in our later class, like in really big detail, like just doing a whole class on Fibonacci lines. So I know this has gone pretty long, so I'm going to go over some of the other indicators very quickly, not in as great as detail as we did the moving averages. And we will be going over all these other indicators in depth for our next couple of charting classes. We'll be like focusing on 1 or 2 indicators. This time we focus on moving average and EMA. So you also have your VWAP, which is your volume weighted average price. And you can get that by going to indicators, clicking VWAP. It's that orange line right there. The VWAP is another way of finding out the support and resistance. So you can use your moving averages, and if you want to confirm, you can click the VWAP tool, and now you have your VWAP here. And basically what the VWAP is it measures the average price at which a stock is traded over a given period of time. And traders can use that to decide whether a stock is bought or sold at a good price, or can be bought or sold at a good price. So in theory, if the price is above the VWAP, in theory it's overpriced, and if it's below the VWAP, in theory it's undervalued, and you want to use that as your support and resistance. And even though when the price is above the VWAP, it's in theory overpriced, it also means that it is on an uptrend, or it can mean it's on an uptrend based off the other indicators, because it means that people are buying it above what it in theory should be. So it means that people, it's in demand. Like if someone, if you have, let's say, you're at a supermarket and people are buying avocados, like they just keep buying it, they keep buying it, even though avocados might only be worth a certain price. If people keep buying it, the price is gonna increase because there'll be less demand for it, or more demand for it, and less available. One big con about the VWAP is that it does lag. So it definitely doesn't update as fast as you would like it to, because the VWAP is used for intraday data. So it's calculated for each day, beginning from the time that the market opens to the time that it closes. So what you would do when trading with the VWAP is you would want to look for, all right, so now the price is below, you see that it crosses above, you want to make sure this is a strong cross above, and you see here it dips, the price dips, but it stays above the VWAP. It dips and it crosses and closes above the VWAP. It dips and it closes above the VWAP. That's how you know, all right, that's like what, 1, 2 times it hit the VWAP and bounced right off of it. Maybe the VWAP is actually being used as the support. So maybe you're going to buy on this candle right here because you're feeling pretty confident that this is your new support. So you buy here, and as you see, it's going up, it's going up, it's going up, and then you would use your other indicators, like maybe the moving average or something here would tell you to sell around here because you bought around here at 1733. You're selling at 1765. But you can't use this alone. You have to use it with other indicators as well. So like right here, it's way below the VWAP. So in theory, it's on a downtrend. It's undervalued. People don't want it as much as what it's worth. And then up here, it goes above, but it's not strong. It goes right below. It's not a strong cross above the VWAP. It goes right back down to downtrending until up here it goes up again. And it closes below, closes above, closes below. It's not very strong, whereas that other one was on the stronger side as far as the VWAP close goes. So right here is showing that the price is, is closing above and then closing below, going above, going below. It's kind of using the VWAP as a price that it's kind of going back and forth to, because it is that, that average price, like what the price should be valued at. So what you want is for it to start going above that and staying above that and using this as a support. And we'll go over all that in detail in another class. Then you have your MACD, which is your moving average convergence / divergence, which is used to reveal changes in strength, direction, momentum, and duration of a trend in a stock's price. So just like all the other lines, it's something you can set. Usually people have it set at 12, 26, 9. I like to do 3, 10, 16, but we'll save it at the 12, 26, 9 because that's what most people use. And basically what it is you have your baseline, which is the 0 line, which you can't really see it right now, but it's that red, it says 0. It goes right across the chart, and that's right in the middle of the chart, that 0 line. And you have the histogram, which is these green and red candles, and then you have your MACD line and your signal line. And the MACD line is basically in this case, your 26 moving average, your 26-day moving average minus your 12-day moving average, whereas the signal line is your 9-day moving average. So it's kind of used the same way as the moving averages, and then the EMA goes. So all you're looking for is for your orange line, your MACD, to cross above the blue line, and that means it's bullish. It means that it's uptrending. And then once it goes above that 0 line, which is that right here, where those red and green candles switch over, that's the 0 line. Once it crosses above that, then it's really bullish. And then basically what the histogram is, and we'll go over all this in really big detail, we'll like do a full MACD class, is the histogram is just showing the space in between the blue and the orange. So it shows how close the lines are to crossing. So when these lines are big, it means that when the histogram is big, like these candles are big, it means that these two lines are farther away from crossing, which means this is a good thing, because if it builds up, like right here, it's building up bigger, 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 bigger. It means that your orange line is going farther and farther away from your blue line, which means it's trending up and up and up and up. And then you see, like right here, it started to trend down a little bit, but came back up. And you can use the MACD line to show different trends. So if you're looking at you're looking for two things basically. You're looking to see if these lines are below the zero line. And if it's below, it means it's in theory trending down. And if it's above, it means it's trending up. But also, as far as the quick price action goes, you want to see when that MACD line, the yellow line, crosses above the signal line. That means that people are buying. We also have the KDJ, which you go under indicators. You can select that as well, KDJ, and it'll come up here and down, or come down here in where the RSI and the MACD is usually shown. I'm going to very quickly go over this one as well, and we'll go over this in detail in one of our classes because this is a little more of a confusing indicator. Basically, the K and the D line is what you're looking for to see if the stock is overbought or oversold. So you see how you have your 100 to 0. So you're looking for like below 20 is oversold. So if these lines are below the 20, it's oversold. If it's above the 80, it's like up here, it's overbought. When the K line crosses the D line, that means that people are selling and buying. So your yellow K line crosses that D line, people are buying. Looks like, and then cross again, people are selling, and so on and so forth. Every time they cross, that means people are buying. So you get your yellow line crossing above, that means people are buying. Cross it below, people are selling. And when the J line, KDJ, your purple line, crosses the two of them, which it does, see how it crosses both of them? That's usually a change of direction. So this shows that people are selling, and the J line crosses down. Now we're trending down, and then boom, crosses up. We're trending up. We'll go over that in detail as well. But basically, you're looking for the K and the D to be crossing each other as far as buying and selling goes, and you're looking for the J to be crossing both of them as far as uptrend and downtrend goes. And you're looking at this number, the 0 through 100, to be looking for overbought to oversold. Speaking of overbought and oversold, we got one of the indicators that a lot of people use, which is the RSI. It's right there. Okay, so RSI is your relative strength index, and this tells you if a stock is overbought or oversold. So basically 0, which it never goes, it doesn't go down to 0, but below 30 would be oversold, and above 70 would be overbought. And just like any of these other calculations, and that's all that these are, like the moving average, the VWAP, the MACD, these aren't magical lines that move, based off of anything other than mathematical equations. All it is all these different indicators are mathematical equations based off of this. It's based off of the price movement. So every time that this happens, it's like an Excel sheet almost. It sends equations to all these other indicators, and that's how these are all formed. There's no, person behind a desk like entering all these things in and telling us like, oh, RSI is now 30, RSI is now 70. It's all based off of the price movement. It's all based off of calculations. And RSI is a very confusing calculation. It uses the last 14 periods, the last 14 days for the calculations. So in a daily chart, it's the last 14 days. In an hourly chart, it's the last 14 hours, et cetera, et cetera. So basically the calculation, and this is going to be super confusing, and I'm not going to go over it in detail until we do our RSI class, but the calculation is RSI equals 100 minus 100 divided by, and then in parentheses, 1 plus the RS, and the RS would be your average gain divided by your average loss. Your average gain is the sum of the gains for the past 14 days divided by 14, and your average loss is the same thing, but with losses. That sounds super confusing, and it is super confusing. But all I'm doing that is to show you that all this is just mathematical equations based off of the past prices, the past 14 days, the past 14 hours, the past 14 minutes, the past 14 whatever you set your chart to. It has nothing to do with anything other than what happened in the past, and that's why you can't use these to predict the future. And no one can predict the future of a stock. No one can tell you what's going to happen. No one can read all these indicators and tell you, oh, it's going to go right up to it's going to hit 1548. I know it for a fact. That's impossible. No one knows these things for a fact. They can tell you, oh, maybe it's going to hit 1536 because that was the past price, and the RSI is, it's oversold or overbought or this or that, the MACD and this and that. They can tell you why they think based off of the past price what might happen, because patterns usually do repeat themselves, but no one can tell you what's going to happen in the future. And all of these indicators, all of these calculations are based off the past, because you can't take future numbers. You can't just pull them out of thin air and put that into an equation. It's all based off the past prices, which is why sometimes people are wrong. Sometimes people look at all these equations and they're wrong. They can only just use past patterns and past price points and past resistances and past supports, but no one can tell you for a fact what's going to happen. So anyway, with the RSI, you're basically looking to see if it can get as close as possible to 30, which is oversold. And that's usually when you would like to buy. And when it's overbought, it means that people are buying it, it's overbought, it's probably going to dump soon. So you don't want to buy it when it's really like up here, it's overbought. You see up here, it's near that 70 line, it's overbought, and then it starts to sell off. People are selling off, and then it gets to oversold here. And stays consolidating. It's even more oversold. Now it's even more oversold. Went down all the way to 28. Now it's starting to come back up again. So in theory, you would buy here, and then you would sell up here, which means you would buy at 1485 and sell at 1533. And that's just the RSI. We'll go over that in detail in our RSI class. Then you have your volume, which once again you go to indicators. You can select volume. The volume is the amount of total shares traded. You also do your dollar volume, which is the volume multiplied by the share price traded at, the amount of money traded basically. And the volume basically measures the numbers of shares traded in a stock or contracts traded in futures or options, depending on what you're looking at. It can be used as an indicator of strength and even market strength. Because if the market or the price, in this case we're just using a price, is rising and the volume is rising, and you can show strong and healthy volume strength. And same deal with the prices fall on increasing volume. The trend is usually on the downside as far as the volume strength goes. So what that means is increasing bullish volume. So as it's increasing, that equals strength. And the same deal with the increasing bearish volume, that equals the opposite of strength. It means it's going down as the strength is decreasing. And just because the prices are going up, you want to look at the volume, because you see it's increasing, but then it's decreasing. So once you see decreasing bullish volume, like right here during an uptrend, it might be a fake out, which right here it starts to go down again. So you have people, the price is going up, but the bullish volume is not going up. So during a breakout, when you see a stock range, when you see the stock's range tighten, it's usually accompanied by a decrease in volume. So let's find where the price is tightening. So in theory, like right here, the stock is kind of consolidating, kind of tightening. You have your volume is, it's kind of decreasing as far as the volume goes, and then all of a sudden that break occurs from this range right over here, and now it's starting to go up, and you got that big spike in volume. Although this one is a bearish spike. And the same concept can be used for a bullish spike. So you see how the price is tightening over here, it's kind of consolidating all in this area, and then all of a sudden, you see that the volume starting to pick up, and then boom, spike in volume. That means that there's going to be a break of price, which boom, it happened right here, it went straight up. So the spike in volume can show us that the trading range is about to break volatility. So, it's not very volatile, then boom, big price action. Now it's just shooting up there. And it means that the movement's probably going to pick up. So now more people are trading it. It's going to get more, probably, more volumes, more interest in the stock. And one way of seeing if a price or if a stock is volatile or not is using the Bollinger Bands. And we'll go over volume more later in a volume-based class. This is just the first class as far as charting goes. We kind of went over a lot, kind of ran over a little bit longer than I was hoping, but going forward, these charting classes, as we do our second one, third one, fourth one, I'll only be going over one, maybe two indicators per class, and we'll go over them in detail. So all these first classes are probably going to be going a little bit longer than the ones in the future will be going, because I'll be able to focus on just one or two things. But the first one I wanted to kind of do like an overview. Like, for instance, last class went over a little bit longer as well, whereas the next one will probably be a little bit shorter because I'll be focusing on just one technique, one trading strategy. So anyway, so either Bollinger Bands, so you see these 1, 2, 3 lines. When they're tightening, when they're all together, it means that the price is consolidating, and it becomes more volatile as the bands get farther apart. So basically, the Bollinger Bands have this center line right here, and then it has two price channels. The top one here, and the bottom right here. So you got your midline, which is the center line, and your upper and lower price channels. And the bands, like I was saying, expand and contrast as the price becomes volatile, or it tightens when the price is less volatile. So usually when it's consolidating, when the bands are tight, it means that something's going to happen soon. It means that, like, maybe you can buy here expecting it to have a breakout. That being said, the breakout could be shooting down, but in this case it did shoot up. So like here, something's happening because it's less volatility. And this is like it's a safer price right here. As far as over here, you have to really watch it. Also, when the price continues to hit that upper band right up here, it typically means that the price is overbought. When the price goes and hits those lower bands, which is the yellow line, the lower bands, it means that the price is usually oversold. So kind of like RSI, kind of like MACD, kind of like all these other indicators, they all kind of tell you similar things. So you had to be able to use them all together. And in one of our future classes, we'll be going over which ones to combine together once we go over all of them in detail. So in theory, you would buy when the price crosses below this yellow line. Let's see. So like right here, it crossed below. It didn't close below. Here it crossed below. So that means that it is oversold right here. So you'd buy here, in theory, and you would sell once it goes up to overbought. So it's oversold, then you buy overbought. Goes down to oversold, then you buy. You buy when it's oversold. Then you wait until it goes to, now it's up here, it's on the overbought, and you would wait until it crosses back below, like right here. Right here is where you would sell. So in this one, you would buy, sell. Here you'd buy right around here, and you would sell as soon as you see that it's starting to get that downtrend. Or you can just use this middle line as a support. So in theory, you buy here, and if it goes below the yellow line again, that might be it crossing down the support. So you buy. Now it's back to oversold. and you could just sell right around here or right around here, or you could wait and see if it crosses down, which it did right here is where you would sell. And that's Bollinger Bands. And then really quickly with the candles, basically the candles, like I was saying, is the top of the candle where it is closing. So on a green candle, it opens on the bottom, closes in the top, and these wicks is the price action during that time period. So, in a 5 minute, this is saying during that 5 minute period, it went up here and then it closed down here. Whereas this one, it started down here, it might have gone down a little bit and then closed up here. Same thing with the red deal, or red candle is the same deal, but opposite. It starts up here and it closes down where the candle stops. And we'll go over that in detail, how to read candle patterns, different charting techniques as far as candles go. We'll go over the 3-point trend, which is where you find a starting point. You find the first high, which is resistance, and you find the pullback level, which would be your support level, and then you find a new high, which would be your new resistance, which is the third point. And once you break, well, we'll go over all that in detail in one of our later classes. But yeah, that's basically charting basics as far as those couple indicators go. Actually, more than a couple. I know this class went pretty long, just like the last class Monday went, so I'm sorry about that. What we do have is we do these classes on YouTube Live. We do like a watch party, or as Facebook, we do a YouTube premiere, I believe it's called, or something. I'm relatively new to how that all works, but we do play these classes live at 8:30 p.m. EST, Eastern Time Zone, every night. And for all of our members who are in these classes during the stream, which is a live stream, I'm going to be in there as well, asking different questions throughout the stream, and I'll be giving away raffle tickets to all of our members who answer these questions correctly, or the best answer. We gave away around like 60 raffle tickets last class on Monday, and so it does help. It does pay to be in here during the live streams because you can get raffle tickets. And also during those live streams, obviously I'll be in the chat during that. So if anyone has any questions, I know a lot of this stuff is really confusing. The past classes were kind of self-explanatory, but charting is a whole nother ball game. So I'll be in there to answer questions as well as give out the raffle tickets. So I definitely want to be there to, if you guys are confused by what I'm going over, I will be in that chat to answer all your questions and kind of clarify things for you. I'll also be in the new members program classroom chat, so you can ask any questions regarding the class there as well. Because I'm not here just to lecture you guys. I'm not here just for the likes and the subscribes and all the other kind of nonsense. I'm here because I want y'all to learn how to trade better. Obviously, I'm not the best. I'm not Oscar Lee, but I do try to inform y'all what I do know and give you the knowledge that I can pass on to you guys. Like I said, this is just a beginning class. We will be going over all this stuff more in detail. But yeah, so definitely, if you're not in the new members program, check it out. You'll be able to ask questions on all this different stuff that we covered. If anything confused you, if you were unsure about anything. And it's also the live streams are definitely worth checking out as well. Those are 8:30 p.m. Eastern Time Zone every night. Right now it's 8:16, so I got to finish this video up so I can post it live. I'm going to go over the homework really quickly from yesterday's class, or all the pre-homework that I went over for yesterday. We're going to get out some raffle tickets for that. But yeah, no, I'm not here just to lecture you guys. I'm not here for the likes or the subscriptions. I'm here to teach y'all. So if you have any questions, please, please, please ask them in the chat. There's no such thing as a bad question, no such thing as a dumb question. We're all new traders. I was asking questions too when I first started out, and I still do. I still ask a lot of questions. So definitely feel free to ask what if you have any questions, feel free to ask them. Don't feel like you can't, or you'll get yelled at, or someone will jump down your throat. That's not going to happen here in the Penny Boys new members program. Also make sure that you check out our trading homework section so you can get some more raffle tickets. This is our post alert quick due diligence homework. So the top 5 answers will get raffle tickets. I'm sorry, the top answer of each question will get 5 raffle tickets. So we're going to be giving away 5 raffle tickets per question. Just gotta make sure I write down the winners so I don't forget who gets those tickets. And the questions are, and this is going over yesterday's class, which was doing quick due diligence on alerts before getting into them. And the first question is, why do we do a quick due diligence before getting into an alert? Second question is, why do we quickly glance at stock quotes and Webull comments of an alert when we're doing the due diligence? So basically, why are we looking at stock quotes and Webull comments really quickly, looking at the stock that we're getting into, looking at those comments, why do we do that? Are the analysts' prediction price a target to shoot for? Why or why not? If an alert is above entry but hasn't hit its target, what could you do? And why do we only trade with money that we can afford to lose? And for today, we did a charting class, obviously. So the pre-class charting homework, just so I can see where everyone's at. Do you know how to use moving averages to find resistance and support? Do you know how to use moving averages to find uptrend and downtrend? Do you know what MACD is? Do you know how RSI is determined? And do you know the difference between the SMA and EMA? So, I'm going to go over some of the questions as far as the pre-class homework, the charting questions, just so we can see who knows what. And then we'll be doing some homework tomorrow, which will be the post-class homework for charting, and hopefully these questions will be, everyone will be able to answer them. So right now, do you know what moving averages to find resistance support? No. Do you know how to find uptrend, downtrend? Yes. Do you know what MACD is? Moving average something? LOL. Do you know how RSI is determined? No. Do you know the difference between SMA and EMA? No. Pre-class homework charting 1 through 5? No. So, hopefully, like I'm saying, the whole reason why we're going over this is so that we can see tomorrow if these same people have different answers. Because I'm going to be asking a lot of these post-question homework, the same exact homework questions, to see if they actually can answer them with the answer other than no. So, well, by the time the class is over, I bet this will change. That's the whole hope. And if you were confused by what I was going over, I'm going to be in the live stream. I'm going to be in the trading class chat after the stream, so you can always ask more questions so that you understand how this all works and so that you can answer the post homework questions for tonight correctly. So the hope is that we're learning here. So looks like this person does have a basic understanding. I believe when trading above moving averages is reaching resistance, while trading below SMA, which is the same as a moving average, to support. So yeah, so it's somewhat of an understanding of how these work. The average volume strength compared to the average price over the given time on the chart. RSI is determined on the average pricing being oversold and overbought, which is correct, yep. And SMA is a simple moving average. Maybe the EMA is estimated moving average. So yeah, so definitely some people have, thank you, Big Nuts 82. Some people do have some knowledge as far as this goes, but they also are, have some stuff to learn, which, we all have stuff to learn. I did a lot of research on these things before doing this class. That's why I'm able to teach these. But my hope is that, because there are a lot of YouTube videos out there, but they'll give you the spiel and they'll say like and subscribe, and that's they'll plug their Discord, or they'll plug whatever their trading platform they use to make money off of is. But then you can't ask them any questions. You can't talk to them. You can't discuss anything with them. Whereas here, I'm not as great of a trader as those guys are, obviously, but what we do offer here is that after these classes, and even during them in the live stream, you can ask questions and you will get answers from the person doing the class. So that's what my hope is as far as like the learning goes. I'm hoping that the hands-on learning is a good way to have everyone learn how all this works. Do you know moving average support resistance? No. Something with moving averages and calculating where price will be? Shrug. No. Who is this? Is this Enigma? Looks like Enigma. Yes, it's Enigma. Enigma's the best. Enigma knows how to answer questions really, really well. Do you know about moving average resistance support a little bit? Do you know moving average uptrend a little bit? Vaguely, not really. So even Enigma is relatively new as far as this stuff goes, even though they answer questions in the best formatting possible. I know that Pookie's Revenge is pretty well versed with this stuff. We talk a lot about these kind of things, so hopefully Pookie's Revenge will. Oh, that's the last one, I think. That's why. Yeah. All right, so now we're going to go over the questions. And remember, I'm sorry, 5 raffle tickets per question per best answer. So the first question, why do we do a quick due diligence before getting into an alert? Those 5 raffle tickets are going to go to Enigma. It's because it's your hard-earned money and you should know what you're getting into. That's 100% correct. You're not going to, in theory, you're not going to go to a store and go blindfold, put a blindfold on and just pick out a random, let's say you're shopping for a TV or a couch. You're not just going to go in with a blindfold and just spin around and point at the first thing that you spin to. You're going to look at all the different prices. You're going to do some research on the different TVs, maybe like the screen quality, or look at the reviews and all that kind of stuff. That's basically what due diligence is for an alert. Is looking at all the reviews, is looking at the screen quality, is looking at if it's the right size for your living room. Like basically, we want to make sure it's the right stock for you, because not every alert is something that you want to get into specifically. Maybe you have 3 oil stocks or 2 oil stocks already. You don't want a third. Maybe you have 2 long plays already. You don't want to get another long play. You want to make sure that it's a stock that is good for your portfolio. And like I said, or like he said, it's your hard-earned money, and you should know what you're getting into. You should look at the data for yourself and see if it fits your own personal strategy criteria, and make sure you're comfortable with the risk and reward, and invest accordingly. So that's going to be Enigma. 1123 gets 5 raffle tickets. Big Nuts 82. Love saying that on YouTube. Big Nuts 82 has won our 5 raffle tickets for question number 2. The reason why you look at Stockwitch and Webull comments is because looking at Stockwitch and Webull comments gives you an idea of what others are thinking and just a general idea of how others feel about the stock. But don't base your investment off of these comments. That's 100% true. It's good to know what other traders are saying. If other traders have interest in it, just you can also see a lot of the times Webull and Stockwitch comments has news posted really quickly there. You can just really quickly look to see, oh, it looks like this happened, or this this is going to happen. You're not going to buy a stock just solely based off of those comments. You're going to you're obviously going to look at to see if it's an alert first. Question number 3 is going to go to Salvador Girl. Are the analyst prediction price a target to shoot for? Why or why not? It's a tool you can use to help guide yourself. So be realistic and look at the charts. Do your own due diligence. A lot of those analyst charts or analyst price predictions, like for instance, like they'll say that a stock that's $2, like it's going to go to like $37. Like it's not going to go to $37. Maybe like in 7 years, but a lot of them are a little bit over embellished. So do your own due diligence and be realistic and look at the chart. It's completely correct. Question number 4 is going to go to Ivy. The question is, if an alert is above entry but hasn't hit targets, what could you do? Wait for the dip, buy in, then once you think it's at the next bottom or support, then you can buy in, or just overall skip that alert, because we get so many, it's okay to pass up on a few, which is 100% true. There are a lot of alerts going out there. You do not need to get into all of them. I can't stress that enough. You do not have to get into all the alerts, especially if you have a smaller account. You can't get into all the alerts. So that's why we do this due diligence. That's why you want to know what you're getting into, so that you can make sure that the ones you get into are worth getting into and for your portfolio and for your trading plan. Also, it's okay to have a stop loss set, and it's okay to, even to lose $5 on 2 quick alerts that, maybe just aren't aren't based off of your trading plan, so that you can have your portfolio available to make that $100 on the next alert, which is part of your plan and fits your portfolio. And question 5 is actually going to be a tie. So 5 raffle tickets will go to Ivy. Why do we only trade with money that you can afford to lose? Because it's your hard-earned money. No one wants to see anyone here lose money because of trading. Trading is risky. Only lose what you can afford. Also, Nick. That's going to be Nick 2086. Just get 5 raffle tickets for that answer because it's our hard-earned money, and there's a possibility we can lose it all. Also, Enigma is going to be getting 5 raffle tickets. Answer being, where do you go? Oh, because it's your hard-earned money, which is correct. And Pookie's Revenge. I know I was looking for the answer, it's your hard-earned money, or a variation of that, but this is also a very good point. It's because we want to make sure we don't take unnecessary risk in the market and outside. Putting money in you can't lose is dangerous and only puts more stress on your trading. And no one wants to be stressed out when trading. I mean, obviously, it's not going to be a zero stress game, but you're going to be way more stressed out if you're using money you can't afford to lose. And know, like everyone else is saying, it's your hard-earned money. You work hard for your money. I don't want you to lose it. You don't want to lose it. No one wants you to lose it. So be careful with your money. Only trade with what you can afford to lose. Ideally, you'll win with it. Speaking of which, one way of helping you make that money is by joining our premium. Just today, we had some great winners. VXRT took another 100% profit in premium. We rode it from $4.30 to $11 the first time, which is almost 200%, and then we took it from $6.80 to $15.50, which is over 100%. So that's a huge profit. BOXL, we got it at the 90s, around the 80s, and then it ran to 273, so that's 203% from our alert. We got another Tesla call, was paid again, another 50% this morning, and we had a 200% Tesla call earlier in the week. So big gains there in our premium. Let's take a look at the profit channel for today. So it looks like Tachua, I can't pronounce that, but they got their first successful option with profit from alerts. Gains are gains, and especially on your first option when you're not losing, that's definitely a good thing. COVID-19 says not as impressive as some of these options, but this is for the 1 month I've been here. Most, if not all, are swings. That's 38% in a month is great. Market was not great today, so instead I switched to shorting. We do have a shorting alerts section as well for the really advanced traders. We do not recommend it for new traders, so actually do not even, I didn't say that. So the market was not great today. Seems to be a play for the today, so we got some good profits, it looks like, today. So finally, that's the end of the class. I'm sorry for all of you who had to sit through all of that. If you did sit through it live, then I hope that you got a bunch of raffle tickets for answering a bunch of questions during our live stream. And I am going to upload this on YouTube, so you can watch, rewatch it if you are confused by anything or wanted to pause it or anything like that. It will be on YouTube. Like, subscribe if you feel like it. If you subscribe, you'll get updates every time I go live and do these classes. You'll also get updates every time I post any of our raffles and punch board drawings. And definitely check out our raffle thread if you're in premium. We gave away $300 worth of Visa gift cards last raffle. I know Ivy won the prior week raffle. I think she won a $20 discount for that, so that's awesome. So congratulations to Ivy. And yeah, check out our new members program. Check out our premium alerts. That's going to be right here at discord.gg/btpenny. That's discord.gg/btpenny. And also join us at our facebook.com/groups/btpenny. We also have an Instagram and a Snapchat as well as a Twitter coming up soon. So I'll be linking those later on once those are all up. So definitely check that out. So we will see you next time. Our Wednesday trading class is going to be advanced trading. So definitely check that out as well. And that'll be live on YouTube. You can subscribe to get an update when that happens. And make sure you join our free Discord, and then from there you can join our premium Discord so you can join me, the Duckman, and make some bread.